Hello and welcome to Looking at the Markets with David Modell. I'm going to show you a day trading strategy that you can try out if you want to, and I will be using the 5-minute candlestick charts, a moving average, and also an indicator, specifically the stochastic indicator. And it's pretty simple, but there's certain rules you want to follow if you're going to try this strategy. Please test it out with demo or virtual trading first to make sure it works before you even consider using real money. All right, I recommend back testing it. Try it out with virtual trading. Don't just try a strategy because you saw it in a video, okay? Make sure it works for you and use small amounts of money, respect your stop losses, and have a plan. I do help people put together a trading or investing plan. If you want some coaching, I can help you with that. I offer coaching, and my email address is davidmodell@gmail.com. All right, so let's get into it. We're going to go to tradingview.com. And I'm using the 5-minute, as you can see, 5-minute candlestick chart for Verizon stock. VZ is the ticker symbol. And each of these candles represents 5 minutes of price action. All right. And you could try it with 1-minute, 2-minute candles, whatever you want. But this particular system that I'll be explaining today uses the 5-minute candles. All right. So I also put the stochastic indicator on TradingView here. And I have it on the standard settings, the default settings, which is 14, 3, and 3. Okay. You could try out other settings, but this method uses 14, 3, and 3. And this strategy does not work perfectly. It does not work 100% of the time. Make your own decisions, do your own due diligence. All right. Be careful out there, folks. All right. So I also have an exponential moving average, the 200 EMA. Okay, 200 period EMA. So what do we have so far? 5-minute candles, 200 EMA. Yes, you can try out SMA instead if you want to, but this strategy uses the 200 EMA and the stochastics on the 14, 3, and 3 standard settings. And just a quick review, yes, you're going to see two lines on the stochastics. You've got the more jagged line there, and that is the blue line, which is the stochastic, the fast stochastic line, the blue one here. But today I'll be paying attention to the orange line, which is smoother, and that is the slow stochastic. Okay, the slow stochastic line is orange. So we're mostly paying attention to that one today because it's less jerky, it's less jagged, it's smoother. All right. It's also a little bit less reactive, which I like. I don't want something that's going to react so quickly, maybe too quickly. All right. So we're going to look at the orange line here, is what I'm saying here, okay? Or whatever color it is on your your platform there. You want to use the slow, smoother stochastic line, all right? Not the fast stochastic for this method. Okay. So the first rule of this strategy is only go long when the candles are above the 200-day moving average, all right? Because you want to trade with the trend, not against it. All right, so that is filter or rule number 1. We're filtering out any trades where the candles are below that blue line there, or whatever color it is on your trading platform, all right? So if the candle is below that line, 200 EMA, don't go long. All right. So for example, over here or here, or even if it's on the line, okay, I'm still not going to take it. All right. I want to be cautious. All right. Then number 2, you want to see if in this case, the orange line, the slow stochastic, is below 20 on the stochastic. Okay. You can see 20, right? That bottom line here. Let me try to find 20 right there. Okay, there it is. You want to see the slow stochastic go below 20 and then pop above it. All right. That's important. I think it's important. Some people take a trade right when the stochastic goes, see if we could see it here, right when the stochastic goes below 20, but you might be catching a falling knife, right? You might be trying to buy when the market is still in a selling mood, when something is still falling fast. You don't want to do that necessarily. So how about waiting until after it goes below 20, the slow stochastic line goes below 20, and then breaks back above it. Okay, that way you're not catching the knife while it's falling. You're waiting until the buyers have stepped in and started to take over from the sellers, take over the momentum. All right. So for example, over here, let's see. Over here, the slow stochastic line went below 20. Good. So now I'm starting to watch, and went over here. It almost touched the 20, didn't go above it, so I'm not taking the trade. And then down here, and here, it popped above it. But am I taking the trade? Let's see. It popped above it on which candle? I'm looking up, up, up. It was this candle right here. Now this candle is right on the 200-day moving average. So am I taking this trade? Am I buying or going long? No, I am not. I am not. I want to see the candle clearly above that 200-day moving average. So I am not taking this trade. I'm not buying, and I'm glad, because look what happened afterwards. You had one green candle and then whoopsies, down, right? So that's why I'm glad I have this filter here, this rule, okay? It's got to be clearly above that 200 EMA. And the slow stochastic has to go below and then pop back above, all right? But it's got to do it with both of those conditions. So I'm not taking that trade. I'm going to be patient. I'm going to stay out of it. I'm going to wait until, let's see, let me move it over here, till it goes below again. Okay, I'm watching, pop back above it. Here it is. Where did it pop back above it? Right on this candle. And as you can see, it's a small candle, but it's above the 200-day moving average. I'm going to take that trade. I'm going to buy. I'm going to go long. All right. Now, when do you get out? Okay, well, you can use whatever method you want to get out. You can use trailing stop losses, or you could use a regular stop loss. There are a number of ways to do it. One way, which I might want to try out, you might want to try out with demo trading, virtual trading, is a 2-to-1 reward to risk ratio. For example, with Verizon stock, I might say, okay, I'm buying here, and if the price, so I'm buying at $55.32. Can you see over here? $55.32. Okay, I'm buying at $55.32. Now, if it goes down, let's say 0.5%, wherever that is, that's my stop loss. Okay, I'm taking a small loss, 0.5%. So if I'm going to have a 2-to-1 reward to risk ratio, that means whatever my risk is right now, 0.5% loss, I need to double that for my profit target. So if I'm going to get out if it goes down 0.5%, I'll also get out if it goes up a full percent. Okay, 1%. All right. So that's an example of my potential reward being twice as big as my potential loss. All right. So 0.5% down. If it goes down that much, I get out for a small loss. If it goes up a full percent, then I get out for a nice gain. Okay, whatever those numbers are. And you can calculate that with, you could do it old school if you want. You could use a calculator, for example. All right, I'll pull out the old, I'll go old school here. Let's pull out the calculator. So if I get in at $55.30, what's my stop loss first? 55.30. If I want to go down 0.5% times 0.995, will take you down 0.5%. So my stop loss would be $55.02. Okay, not a bad way to go, which is around right there. Okay, from here to here, I could lose that much. What about the profit target? Well, if I'm buying at 55.30 times 1.01, that's adding 1%, $55.85, let's say, which is 55.85, right there. Not bad. I would gain from here all the way up to there. Okay? That's just one way to do it. All right, but I want you to find your own way. And maybe you have a more efficient method than pulling out the calculator than me, but I'm kind of old school. Okay? Here's another example. The orange line, slow stochastic, it went below 20, back above it right here. Let's look. Is that candle above the 200-day moving average? It is. I would take the trade. Okay. And let's say if it goes down 0.5%, I get out for a small loss. That's my stop loss. If it goes up 1 full percent, I'd get out. Let's say that's my profit target. All right. So let's see. Let's look at another example. It's above the 200-day. Now this is interesting. Over here, the blue line, the fast stochastic, went below 20, but the orange line did not. So I would not take that trade. It went below it here, just barely, but it did. Then it popped back above it. Where? This candle right here. As you can see, it went up afterwards. So I probably would have done okay with that. Okay? Does not work perfectly. Does not work 100% of the time. It's just an idea. So I hope this is helpful to you. And if you like this method, if you want to give me a thumbs up on YouTube, you can do that. If you want the coaching, email me for the coaching at davidmodell@gmail.com. I want to thank you so much for watching and listening. I will talk to you again soon.